Before we begin, please remember that I am not a financial advisor. This video is for informational and entertainment purposes only. The content presented here is not intended to be a substitute for professional investment advice. All investment strategies and investments involve risk of loss. Please consult with a licensed financial professional before making any investment decisions. You open the app. The design is clean, maybe a vibrant green or a cool blue. Feels less like a Wall Street bank and more like your favorite video game. You search for a stock you've been hearing about, maybe a tech giant or that car company everyone's tweeting about. You tap buy. You enter the number of shares. You swipe up. Confetti explodes across your screen. Congratulations, you're an investor. The whole process took less than 30 seconds. And the best part? It was free. The commission was $0.00. Feels revolutionary. It feels like you've finally been given the keys to a kingdom that was once locked away for the rich and powerful. You've democratized finance right from your couch. But what if I told you that in that fraction of a second between your swipe and the confetti explosion, something else happened? Something you didn't see. What if I told you that your simple buy order didn't go straight to the New York Stock Exchange? What if, instead, it was sold? Sold to the highest bidder in a private high-speed auction you never knew was happening? And what if I told you that the entire multi-billion-dollar valuation of these free trading apps is built not on serving you, but on selling you? Because the most important rule of the modern internet applies directly to modern finance. If you are not paying for the product, you are the product. This is the story of how zero investment trading apps really work. And to understand it, we have to forget everything we think we know about how the stock market functions. You, the retail investor, are not their real customer. You are the merchandise. The real customers are a group of shadowy, ultra-powerful firms you've probably never heard of. Companies with names like Citadel Securities, Virtu Financial, and Susquehanna International Group. These are not your grandpa's stockbrokers. They are high-frequency trading Goliaths, or market makers. They operate on a scale and at a speed that is almost incomprehensible, using supercomputers and fiber optic cables to execute millions of trades every single second. And they are willing to pay your free brokerage app hundreds of millions of dollars a year for one thing: your trades. This business model has a name. It's called Payment for Order Flow, or PFOF. And it is, without a doubt, the most controversial and misunderstood engine of modern retail investing. So how does it work? Let's use an analogy. Imagine you want to buy a gallon of milk. The old way of doing things would be to go to the public farmers market. Let's call that the New York Stock Exchange. You'd see all the prices from different sellers, and you'd buy from whoever gives you the best deal. It's transparent. It's open. Now imagine you use a free grocery delivery app. You place your order for that gallon of milk. But instead of the app's driver going to the public farmers market, the app calls up a massive, private mega supermarket. Let's call it Citadel Superstore. The app says, "Hey Citadel, I have a customer who wants a gallon of milk. How much will you pay me to send them your way?" Citadel Superstore pays the app a small fee, and in return they get your order. They sell you the milk and everyone seems happy. Your app got paid. You got your milk delivered for free. But here's the catch. Citadel Superstore isn't just a supermarket. They have access to millions of these free delivery app orders. They see in real time who is buying milk, who is selling cheese, and who is stocking up on eggs all across the country. This fire hose of information is unbelievably valuable. And because they get to execute your order in their own private store, they get to control the price. In the stock market, this price is determined by something called the bid-ask spread. Sounds complicated, but it's simple. For any stock at any given moment, there's a price someone is willing to buy it for, that's the bid. And there's a price someone is willing to sell it for, that's the ask. The ask is always slightly higher than the bid. The tiny gap between those two numbers is the bid-ask spread. For a highly traded stock like Apple, this spread might be just a single penny. For example, the bid could be $170, and the ask could be $170.01. That 1 cent gap is the market maker's playground. It's their profit zone. When you place a buy order on your free trading app, it gets routed to a market maker like Citadel. They see the public market spread is 1 penny. The best available price to buy on the open market is $170.01. But because they are a massive wholesaler of stocks, they can fill your order from their own inventory. So they sell you the share for $170.005, half a penny cheaper than the best public price. Your app then sends you a notification. Congratulations! We got you price improvement. You saved half a cent. And you feel great. You beat the system. But what really happened? The market maker Citadel bought that same share for $170 on the other side of the market and sold it to you for $170.005. They just made half a cent. Half a cent. Sounds like nothing. It's practically worthless. But you have to understand the scale. We are not talking about one trade. We are talking about millions upon millions of trades every single day. Citadel Securities alone handles over 40% of all retail stock trades in the United States. Let's do some quick, back-of-the-napkin math. In 2021, Robinhood received about $687 million from market makers for routing trades to them. That's just one app. Charles Schwab, which also offers commission-free trading, made over $1 billion from payment for order flow. That half a cent, multiplied by a tidal wave of retail orders, becomes a multi-billion-dollar-a-year industry. An industry built on your free trades. The market makers get incredibly valuable data on retail sentiment, and they get to profit by capturing a piece of the bid-ask spread on millions of orders. Your brokerage gets paid hundreds of millions for delivering you to them. And you get confetti and a price improvement of a fraction of a penny, never knowing that the market maker captured the other fraction of the penny that could have potentially been yours in a more competitive marketplace. The defenders of this system, including the brokerages and the market makers themselves, argue that PFOF is a win for everyone. They say it has enabled commission-free trading, which has allowed millions of new people to access the markets. They argue that the price improvement, however small, is proof that the system benefits retail investors. They claim that without this system, commissions would have to come back, and investing would become expensive again. But critics, including the chairman of the SEC, Gary Gensler, have raised serious questions. They ask, is this really a free market? Or is it a private system where retail orders are segregated and sold, preventing them from ever interacting with the wider market where they might get an even better price? Is the price improvement you receive truly the best price possible? Or is it just a sliver of the profit designed to keep you happy while the market maker keeps the rest? It creates a fundamental conflict of interest. Is your broker legally obligated to get you the best possible execution for your trade? Or is there real incentive to route your trade to whichever market maker pays them the most? This isn't just a theoretical debate. It's a battle for the soul of the U.S. stock market. It's a fight over whether the game is truly fair, or if it's been subtly tilted in favor of the largest, fastest, and most powerful players. The secret behind the free trade isn't a gift. It's a business model. A fantastically profitable one that has turned your trading activity into the fuel for a new kind of Wall Street machine. And payment for order flow is only the beginning. It's the most visible gear in a much larger, more complex engine. Because how they make money off your stocks is just one piece of the puzzle. The real magic and the real danger might just lie in what they do with your cash. So let's talk about your cash. That $1,000 or $10,000, or maybe just $50 you transferred into the app, ready to pounce on the next big opportunity. You see it right there in your portfolio, listed as buying power or withdrawable cash. Feels safe. Feels like it's just sitting there, waiting for your command. But it's not. It's one of the hardest working piles of money in the financial system. And it's not working for you. When you deposit money into one of these brokerage apps, you're not putting it into a simple digital wallet. You are unknowingly participating in something called a cash sweep program. It sounds harmless, almost tidy, like they're just cleaning up. But what they're sweeping is your money, and where they're sweeping it to is a complex network of outside banks. These aren't just any banks. They are program banks, and they have a very special relationship with your brokerage. Here's how it works. Your brokerage takes all the uninvested cash from you, and millions of other users, and bundles it together into a colossal multi-billion-dollar mountain of money. They then deposit this mountain of cash into these partner banks. Now, why would they do that? Why not just keep it in their own accounts? Two reasons. First, by spreading the money across multiple banks, they can offer you a higher FDIC insurance limit. Instead of the standard $250,000, they can advertise that your cash is insured up to $1 million or even $2 million. This is a huge selling point. It makes you feel secure, confident. It encourages you to park even more cash in your account, thinking it's as safe as a fortress. But the second reason is where the real money is made. These partner banks are hungry for deposits. Deposits are the lifeblood of a bank. It's the money they use to lend out for mortgages, car loans, and business loans. And for a stable, massive, multi-billion-dollar deposit from a brokerage, they are willing to pay a very handsome interest rate. Think of it like a bulk discount. A single customer depositing $1,000 might get a standard savings rate. But a brokerage depositing $10 billion? They get the VIP rate, a premium wholesale interest rate that you, as an individual, could never access. Let's put some real-world numbers on this. As of this recording, the federal funds rate, the target interest rate set by the Federal Reserve, is hovering around 5%. This means banks are paying high rates for cash. A partner bank might pay your brokerage an annual rate of, say, 4.5% on that mountain of cash. So, on $10 billion of user cash, the brokerage is earning $450 million a year from its partner banks. For free. Now, what do they pass on to you? This is the billion-dollar question. Some apps, especially in a high-interest rate environment, might offer you a piece of the pie. They'll call it high-yield cash or a cash management account, and pay you, say, 3% interest. That sounds great, right? You're earning interest on your uninvested cash. But look closer. They are earning 4.5% and paying you 3%. They are pocketing the 1.5% difference. That 1.5% spread on $10 billion is still $150 million a year in pure, effortless profit. But many platforms for a long time paid you much, much less. Some paid a fraction of a percent. Some paid nothing. Zero. They would collect the full 4.5%. All $450 million, and you, the actual owner of the money, would get nothing but a line item on your screen that said buying power. Your money was funding their entire operation, and you were none the wiser. This isn't a small side hustle for these companies. It is a foundational pillar of their business model. In their quarterly earnings reports, they don't hide it. They call it net interest revenue, and it often accounts for half or even more of their total revenue. It's a quiet, relentless money-making machine that runs 24/7, powered by the inertia of millions of people. They are banking on you leaving cash in your account. They've designed their platforms to encourage it. The user interface is slick and engaging. Transferring money out can sometimes have a waiting period, or it just feels like more of a hassle than leaving it in. They want you to feel like that cash is a coiled spring, ready for action. But for every day it sits there uninvested, it's not a coiled spring for you. It's a golden goose for them. Every single dollar of every single user every single night is swept up, shipped out, and monetized. So we have two powerful, mostly invisible revenue streams so far. First, they lend out your stocks to short sellers and collect a fee. Second, they take your uninvested cash, lend it to other banks, and collect a massive interest payment. Both of these happen in the background without you having to lift a finger, or even be aware that it's happening. This is the engine of free trading. It's the cost of admission you pay without ever seeing the ticket. And if this was the whole story, it would already be a fascinating, slightly unsettling business model. A model built not on what you do but on what you don't do. On the stocks you hold and the cash you let sit. It's a business of inertia. But that's not the whole story. Not even close. Because the money they make from your idle assets is a steady, predictable stream. It's reliable. But the real, explosive, and infinitely more controversial source of their income comes from the exact opposite of inertia. Comes from the moment you take action. The moment you see a stock you like, type in the number of shares, and your finger hovers over that bright green button that says, buy. What happens in the fraction of a second after you click that button is the dark secret of the modern stock market. It's a practice so lucrative and so complex that it has fundamentally rewired how Wall Street operates. It has nothing to do with your cash sitting still, or your stocks being loaned out. It has everything to do with the trade itself. Your decision. Your click. Because that click, that simple instruction to buy one share of stock, is instantly sold to the highest bidder before it ever reaches the stock market. This is a practice known as payment for order flow, or PFOF. And it is the secret, multi-billion-dollar engine that powers the entire world of zero-commission trading. It's the answer to the question. It's how they get rich off of your free trades. So what does it mean? Who is buying your click and what are they doing with it? Imagine you walk into a grocery store. This store, let's call it BrokerMart, tells you that you can have a personal shopper for free. This shopper will run and get any item you want, no charge. Sounds great, right? So you say, okay, I want to buy one share of Apple. You give your order to the free personal shopper. Now, you assume your shopper is going to run to the big central farmers market where everyone buys and sells apples. Let's call that the New York Stock Exchange. That's where the prices are public, transparent, and competitive. But your shopper doesn't go there. Instead, they walk out the back door and go to a massive, private warehouse owned by a company we'll call mega wholesaler. This mega wholesaler is a giant. They trade more apples in a day than most countries see in a year. And here's the kicker. Mega wholesaler pays your personal shopper, BrokerMart, a small fee for bringing your order directly to them. Why? Why would they pay for your little order to buy one apple? Because mega wholesaler has a massive informational advantage. They have thousands of other personal shoppers from thousands of other BrokerMarts all bringing them orders. They see in real time who wants to buy apples and who wants to sell them. And they can use that information to make a tiny, almost invisible profit on your transaction. In the real world, your broker app is BrokerMart. And mega wholesaler is a high-frequency trading firm, a market maker. These are the titans of Wall Street, names you might have heard of but don't really know what they do. Firms like Citadel Securities, Virtu Financial, Susquehanna. These aren't your grandpa's investment banks. They are technology companies disguised as financial firms, armed with supercomputers, armies of PhDs in physics and mathematics, and private fiber optic cables, all designed to do one thing: trade faster and smarter than anyone else on the planet. And your broker? They are feeding your trades directly into the mouths of these leviathans. In 2021 alone, firms like Robinhood made over $1 billion, not from you paying commissions, but from these high-frequency trading firms paying them for your order flow. So, how do they actually make the money? It all comes down to a tiny gap in price that exists for every stock, every second of the day. It's called the bid-ask spread. It's simpler than it sounds. At any given moment, there are two prices for a stock. There's the bid price, that's the highest price a buyer somewhere in the market is willing to pay for a share. And there's the ask price, that's the lowest price a seller is willing to accept for that same share. Let's say you want to buy a share of company X. The bid price might be $100 even. The ask price might be $100.01. That 1 cent difference is the spread. It's the Grand Canyon of high-frequency trading. An entire universe of profit exists inside that single penny. When you place your order to buy that share on your free trading app, that order is zapped over to a firm like Citadel Securities. Citadel now becomes the counterparty to your trade. They are the ones who will sell you the share. They don't have to go out to the public market, the NYSE, and buy a share for you. They often already have a massive inventory of shares, or they can acquire it in microseconds from other sources. Here's the magic. They see the public market ask price is $100.01, but they can sell you the share for a price inside that spread. They might sell it to you for $100.008. You look at your phone and see your order was filled. You got your share. But what just happened? Citadel, the market maker, likely bought that share, or an equivalent one, for something like $100.002. They bought low, sold high. They made a profit of 0.6 of a cent. You're probably thinking, 0.6 of a cent? Who cares? That's nothing. And for your one trade, it is nothing. But Citadel isn't just handling your trade. They are handling millions and millions of trades. Every minute, every day. Those fractions of a penny, when multiplied by an insane volume, turn into a torrent of cash. It's like standing in a light drizzle and collecting one drop of rain, versus standing in a hurricane with a bucket the size of a football stadium. They are playing a game of scale and speed that is almost unimaginable to a retail investor. Now, the brokers and the high-frequency traders will defend this practice vigorously. They have a very compelling argument. They call it price improvement. They will tell you that this system is actually good for you. They'll point to that trade and say, look, the best price available on the public stock exchange was $100.01. We sold it to you for $100.008. We saved you 0.2 of a cent. We improved your price. And technically, they're not wrong. You did get a price that was slightly better than what was publicly listed. Your broker will then publish statistics saying that 98% of their customer orders receive price improvement. They frame it as a win-win. You save a fraction of a penny, they get paid by the market maker, and the market maker makes their own fraction of a penny. Everyone goes home happy. But this is where the story gets murky, because this price improvement narrative, while technically true, masks a much deeper and more troubling question. Is that the best price you could have gotten? The very system is built on a fundamental conflict of interest. Your broker has a legal obligation called best execution. They are required by law to get you the best possible price for your trade. But they are also being paid handsomely to route your order to a specific firm. So, is their primary incentive to fulfill their legal duty to you? Or is it to maximize the revenue they receive from the high-frequency traders? Are they sending your order to Citadel because Citadel offers the absolute best price in the entire financial universe? Or because Citadel writes them the biggest check? The defenders of PFOF argue that competition between firms like Citadel and Virtu is so fierce that they are forced to offer excellent price improvement to win the broker's order flow. They say the market's own competitive nature solves the conflict of interest. But critics argue that's a smokescreen. They say that by routing all these retail orders away from the public exchanges, like the NYSE and the NASDAQ, and into these private darker systems, the market makers are getting an exclusive first look at the intentions of millions of small investors. This is valuable data. They see the tidal wave of retail sentiment forming before anyone else. They know what the dumb money is doing, and they can position themselves to profit from it. Think about it. These HFTs are paying hundreds of millions of dollars a year for this data, for this order flow. Do you really think they're doing that just to give you a discount? Or is it possible that the value they extract from seeing your order is far, far greater than the tiny price improvement they kick back to you? They are essentially paying for a peek at your cards before you play them. They give you a single chip back as a thank you for letting them look, all while they're calculating how to win the entire pot. The price improvement you receive might not be a gift. It might just be the cost of doing business. The price they pay to keep the public happy and the regulators at bay, while they operate a system that is overwhelmingly tilted in their favor. So while on the surface you got a good deal, a free trade and a fraction of a cent in savings, you have to ask yourself what the hidden cost is. What happens when the majority of retail trades never even touch the public lit markets? What does that do to the very concept of a fair and transparent price for a stock? This isn't just about pennies. This is about the fundamental structure of the US stock market. And it reveals that the democratization of finance might have just been a marketing campaign for a new, more efficient way to put the small investor at a permanent, structural disadvantage. The game didn't change. They just built a beautiful, user-friendly front door to the same old casino. But even this is just scratching the surface. Because the profit they make on the spread, and the data they get from your order, is only part of the story. The real power they wield comes from what happens next. It comes from their ability to not just react to the market, but to actively shape it. What if the very act of processing millions of retail orders gives them the power to influence the prices you see on your screen? This isn't a conspiracy theory from a dimly lit corner of the internet. It's a documented multi-billion-dollar strategy built on two fundamental forces: speed and information. The power doesn't come from some grand manipulative scheme to crash the market. It's far more subtle and far more profitable. It happens in the microscopic gaps of time and price that exist between your phone and the actual stock exchange. Let's talk about speed first. Imagine you're at a massive ticket counter for a rock concert, and you want to buy a ticket for exactly $100. You place your order, but your order doesn't go straight to the main ticket office. Instead, it goes to a middleman standing right in front of the counter. This middleman sees your order for $100. He also sees 10,000 other people behind you who also want to buy a ticket for around $100. Because he has this fire hose of information, he knows a wave of demand is about to hit. So, in the split second before he processes your order, his superhumanly fast assistant sprints to the ticket window and buys up all the available tickets for $99.98. Then, he turns around and sells one of those tickets to you for your price, $100. He just made 2 cents. Sounds insignificant, right? But he does this for you and for the 10,000 people behind you. Then he does it a million more times before lunch. This, in essence, is a simplified version of what's known as latency arbitrage. The market makers, with their fiber optic cables running directly into the exchanges and their quantum-level processing servers, are the fast assistants. They can see your order coming, and they can literally race ahead of it to the public market. Your order to buy 1 share of Tesla at the market price travels from your phone, through the internet to your broker's servers, and then to the market maker. That journey takes milliseconds, which is an eternity in modern finance. In that tiny window of time, the market maker's algorithms have already processed your intent. They've aggregated it with millions of other retail orders and calculated the immediate, short-term impact on the stock's price. They then use their own capital and high-frequency trading infrastructure to execute trades based on that knowledge, fractions of a second before your order is ever filled. They might buy up shares at a slightly lower price, knowing a wave of buy orders is coming to push the price up. Or they might offload shares, knowing a wave of selling is imminent. They are surfing the very wave that you and millions of others are creating, and they're skimming a tiny profit off the top of every single ripple. The profit on your individual trade might be less than a penny. It's so small you would never notice it. It doesn't even feel like you lost anything. You still got the price you expected or very close to it. But when you multiply that fraction of a penny by the hundreds of millions, or even billions of shares that retail investors trade every single day, you are looking at one of the most powerful money-making machines ever invented. This is a core part of how they monetize free trading. They aren't just selling your order. They're selling the intelligence your order contains, and using their speed to act on it first. But speed is only half of the equation. The other half is information, and this is where the story gets even murkier. This is where we leave the relatively open public markets and enter the world of dark pools. The name itself sounds ominous, and for good reason. A dark pool is a private stock exchange. It's an alternative trading system, completely legal, that operates outside of the public view of the New York Stock Exchange or the NASDAQ. There are no flashing tickers, no screaming traders on a floor. It's a network of servers in a data center, typically in New Jersey, where trades happen in the dark, away from public scrutiny. Originally, these were created for a legitimate purpose. Imagine a giant pension fund wants to sell 10 million shares of Microsoft. If they dump that massive order onto the public market all at once, the price would plummet, and they'd get a terrible deal. So they use a dark pool to find another large institution that wants to buy a huge block of shares, and they execute the trade privately without spooking the public market. But market makers like Citadel Securities and Virtu Financial operate some of the largest dark pools in the world. And because of payment for order flow, they have the right to route your order wherever they see fit. Very often, the most profitable place for them to send your order is to their own in-house dark pool. This is a process called internalization. Think about it. Why would they send your buy order for Apple to the public New York Stock Exchange, where they have to compete with thousands of other buyers and sellers, when they can simply handle it themselves? Inside their dark pool, they are the house. They control the game. When your buy order comes in, their system first checks if another retail investor using another app has just submitted a sell order for the same stock. If they find a match, perfect. They can execute the trade between the two of you right there in their private system. What's the benefit for them? They get to capture the entire bid-ask spread. On the public market, there might be a bid price to buy a stock at $100 and an ask price to sell it at $100.02. That 2-cent gap is the spread. By matching a buyer and seller inside their own pool, the market maker can pay the seller $100, charge the buyer $100.02, and pocket the entire 2-cent difference risk-free. They didn't have to compete with anyone. They just played matchmaker and took a fee. Now, regulators have a rule for this. It's called the National Best Bid and Offer, or NBBO. It mandates that even if your trade happens in a dark pool, you must be given a price that is at least as good as the best available price on the public market at that moment. And on paper, this protects you. The market makers will proudly state that they often provide price improvement, giving you a price that's a fraction of a cent better than the NBBO. But here's the critical, unanswered question that hangs over this entire system. What if your order had never been diverted to that dark pool in the first place? What if your buy order had been allowed to go to the public exchange to interact with the full depth of the market? Could it have pushed the price up and discovered a seller willing to part with their shares for an even better price? By sending your order to a private venue, the market maker prevents what's called price discovery. They prevent your demand from having its natural effect on the market. You got a fair price, yes. But did you get the best possible price? Or did you just get the price that was most profitable for the middleman? The truth is, it's impossible to know. That's the nature of a dark pool. The system is designed to be opaque. It's a world of private agreements, internalized trades, and microscopic profits skimmed from an information advantage that retail investors simply do not have. So you hit buy on your free app. In milliseconds, your order is sold to a market maker who uses their superior speed to trade ahead of you on the public market, or routes your order into their own private dark pool to capture the full spread. This is the engine of zero-commission trading. It's a high-tech, brilliantly engineered system that transforms your small-time trades into a multi-billion-dollar revenue stream. For years, this system operated perfectly silently in the background. It was a finely tuned machine, processing the predictable, disorganized flow of millions of individual investors. But the machine was only designed to handle a gentle stream. What happens when the fire hose of retail orders becomes a tidal wave?
Disclaimer. The information presented is for informational purposes only. and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
All aimed at a single obscure stock. What happens when the retail investors stop being disorganized and start acting like a single massive hedge fund? The system wasn't built for that. And when it was finally tested, the people who designed the game had to decide whether to change the rules mid-play. And on the morning of January 28, 2021, they didn't just change the rules. They took the ball, unplugged the console, and told millions of players the game was over. For a few frantic hours on Robinhood and several other zero-commission apps, you could sell GameStop, but you couldn't buy it. The button was just gone. The message was clear. Get out, but don't you dare come further in. To millions of retail investors, this felt like the ultimate betrayal. A conspiracy in broad daylight. The moment David was about to land the final stone, Goliath's friends on the sidelines tackled him. The hedge funds were bleeding billions, and suddenly the one weapon the retail army had, the ability to buy and hold, was disabled. The narrative wrote itself. Wall Street saw it was losing its own rigged game, so it flipped the table. And while that narrative is emotionally true, the mechanical truth of what happened is far more complex, and frankly, far more terrifying. It reveals that the free and open market we believe in is built on a series of pipes and valves that can be shut off at any moment, not by some shadowy cabal, but by the system's own automated self-preservation instincts. To understand why the buy button vanished, you have to look past the shiny interface of your trading app and into the grimy, archaic plumbing of the stock market itself. When you tap buy on a stock, you feel like it's instant. You see the shares in your account, the money leaves your balance. Feels like a digital handshake, but it's not. In reality, you've just created an IOU. The actual exchange of your money for the seller's shares doesn't happen for 2 full business days. This is called T+2 settlement, a relic from an era of paper stock certificates and messengers running through Wall Street. For those 2 days, both you and the person on the other side of the trade are living on a promise. What if, in those 2 days, the brokerage you use goes bankrupt? What if the seller's brokerage goes under? Who makes sure the trade actually happens? This is where the most important company you've never heard of comes in. The Depository Trust and Clearing Corporation, or DTCC. Think of the DTCC as the market's central nervous system and armored security guard, all rolled into one. It sits in the middle of almost every single trade, guaranteeing that if a buyer or seller fails to make good on their promise, the DTCC will step in and complete the transaction. It prevents a single failure from causing a catastrophic domino effect across the entire financial system. But the DTCC isn't a charity. It doesn't take on all this risk for free. To protect itself, it requires every brokerage from Goldman Sachs to Robinhood to post collateral. This is essentially a giant security deposit. The amount of collateral a broker has to post is based on a complex formula, but it boils down to one simple question. How risky are your customers' trades? If your customers are mostly buying stable blue-chip stocks, your risk is low, and your collateral requirement is manageable. But if your customers are all piling into a single absurdly volatile stock, a stock that's swinging hundreds of dollars a day, a stock that hedge funds have bet billions against, well, your risk profile goes through the roof. And that is exactly what happened with GameStop. The sheer volume and unprecedented volatility created a ticking time bomb inside the DTCC's risk algorithms. From the clearinghouse's perspective, Robinhood wasn't just a broker anymore. It was the epicenter of a potential earthquake. Every new buy order for GameStop from a Robinhood user was another stick of dynamite thrown onto the pile. The risk of someone, somewhere in the chain, defaulting was becoming astronomical. What if the price crashed back to $20 before the trades could settle? What if Robinhood itself couldn't cover the positions? The DTCC's job is to prevent that what if from ever happening. So, in the pre-dawn hours of January 28th, the system did its job. An automated alert went off. The risk was too high. The DTCC's subsidiary, the National Securities Clearing Corporation, made a phone call to Robinhood. They told them their collateral requirement, their security deposit, was no longer a few $100 million. They needed to deposit $3 billion. Immediately. Not by the end of the week. By 9:30 a.m. Imagine getting that call. You are a Silicon Valley startup, albeit a large one, and the financial god entity that allows you to exist has just told you to come up with a sum of money larger than the entire GDP of some small countries, and you have about 3 hours to do it. Robinhood didn't have $3 billion in cash lying around. No company does. They were facing an existential threat. If they couldn't meet the deposit requirement, the DTCC would essentially shut them down. They would be restricted from all trading, their business would be over, and the fallout for their millions of customers would be catastrophic. So they had two choices: die or do something to drastically and immediately lower their risk profile in the eyes of the DTCC. How do you do that? You stop pouring gasoline on the fire. You stop allowing new risky trades to be initiated. The riskiest trades, the ones driving this unprecedented volatility, were the buy orders for GameStop and a handful of other meme stocks. Selling, on the other hand, actually reduces a broker's risk. When a customer sells a volatile stock, it closes out a risky position, which in turn lowers the broker's collateral requirement. This is the cold, mechanical reason the buy button disappeared. It wasn't a cigar-chomping hedge fund manager calling his buddy Vlad Tenov and telling him to screw over the little guy. It was a desperate, panicked act of survival. By restricting the purchase of these specific stocks, Robinhood could go back to the DTCC and say, "Look, we've contained the risk. The fire is no longer spreading. You don't need $3 billion from us anymore." And it worked. After frantic negotiations and proving they had taken these drastic measures, the DTCC lowered their requirement from $3 billion to a more manageable, though still enormous, $700 million. Robinhood then had to scramble, drawing on its credit lines and getting emergency cash infusions from its investors just to meet that new, lower number and keep the lights on. The zero-commission model was a key part of this crisis. These apps were built for scale, to onboard millions of users as frictionlessly as possible. But they weren't built with the fortress-like balance sheets of old-school brokerages like Fidelity or Schwab. Their massive, highly engaged user base was their greatest asset. But in this moment, it became their greatest liability. They had successfully democratized access to the market, but they hadn't anticipated what would happen when the democracy turned into a mob, and the mob decided to storm the castle. The very system that allowed them to offer free trades was the same system that buckled first under the pressure. The decision to halt buying saved Robinhood from imploding, but it may have destroyed its soul. In that moment, they were forced to choose between their own survival and their customers' freedom to trade. They chose survival. But this raises a terrifying question. Was this a one-time freak accident, a black swan event caused by a perfect storm of social media, memes, and market mania? Or did the GameStop saga simply expose a fundamental feature of our modern market? A feature that shows when things get truly chaotic, the house will always protect itself, even if it means locking the players in or out to do so. The system didn't just bend, it showed us exactly where its breaking points are, and who gets crushed when it snaps. And the people who got crushed were the ones who believed the game was finally being played on their terms. They were the ones holding the GameStop shares, watching the rocket ship refuel, only to see the launchpad doors sealed shut from the outside. The outrage was immediate and volcanic. Accusations flew. Robinhood was in bed with the hedge funds. They were protecting their billionaire buddies at Citadel. It was a conspiracy to rob the little guy. And while that narrative is emotionally satisfying, the truth is far more complicated, and in many ways far more terrifying. Because it wasn't a shadowy cabal of cigar-smoking villains that stopped the squeeze. It was a machine. A vast, invisible, and utterly indifferent piece of financial plumbing that most people have never even heard of. To understand what really happened, you have to look past the trading app on your phone, past the stock tickers, past even Wall Street itself, and into the basement of the entire system. Down there, you'll find the Depository Trust and Clearing Corporation, or the DTCC. Now, that sounds incredibly boring, and that's by design. The DTCC is like the water treatment plant and sewer system for the financial world. You don't think about it, you don't want to think about it, but if it stops working for even a few hours, civilization as we know it grinds to a halt. Its job is to make sure that when you buy a stock, you actually get the stock, and when the other person sells it, they actually get your money. It's the great, anonymous middleman that guarantees trillions of dollars in transactions every single day. Here's the secret that underpins the entire market. A secret that most retail traders have no idea about. When you click buy on a stock, nothing actually happens instantly. You see the shares appear in your account, the money disappears, and you think it's a done deal. But it's not. The actual exchange of the stock for the cash takes 2 full business days to officially settle. This is called T+2 settlement. It's a legacy of a time when stock certificates were physical pieces of paper that had to be hand-delivered by messengers. Even in our digital age, that 2-day lag still exists. And in that 2-day gap lies a massive amount of risk. Think of it like this: you order a pizza online. The app says, your pizza is on its way. But for 2 days you don't have the pizza, and the pizza place doesn't have your money. What if, in those 2 days, the price of cheese skyrockets by 1,000%? What if the pizza company goes bankrupt? What if you, the buyer, suddenly have no money in your account when they try to charge you? The pizza company is on the hook. They promised you a pizza at a certain price. The DTCC's subsidiary, the NSCC, is the ultimate guarantor of all these pizza deliveries. And to protect the whole system from collapsing, it requires every single pizza place, every broker like Robinhood, Fidelity, or Charles Schwab to post a security deposit. This is called collateral. It's a giant pile of cash they have to park with the NSCC just in case things go wrong. For normal stocks, on normal days, this collateral amount is predictable. It's based on the volume of trades and a bit of standard market volatility. It's a manageable cost of doing business. But GameStop was not a normal stock on a normal day. GameStop was a supernova. It wasn't just a few people ordering a pepperoni pizza. It was millions of people, all at once, ordering a pizza whose main ingredient was pure, uncut lightning. A pizza whose price was doubling every hour. The risk wasn't just that someone might not be able to pay for their pizza in 2 days. The risk was that the entire financial system might not be able to handle the sheer explosive energy of the transaction. The NSCC's risk algorithms, the cold, calculating heart of the machine, saw this unprecedented volatility and did what they were programmed to do. They panicked. They saw a broker, Robinhood, whose entire customer base was stampeding into this single hypervolatile stock. From the NSCC's perspective, Robinhood was a small pizza chain that had suddenly promised to deliver 1 million lightning pizzas. The risk that Robinhood might not be able to cover the cost in 2 days was astronomical. So, in the dead of night at 3 a.m. on Thursday, January 28, 2021, the executives at Robinhood got a call. It was the NSCC, and the message was simple: your security deposit is no longer enough. The risk you are carrying is too great. For decades, their collateral requirement had been around 2% of the value of their customers' trades. But now, because of the insane volatility in stocks like GameStop and AMC, the NSCC was demanding 100% collateral. They looked at the billions of dollars worth of GameStop shares their users were buying and said, "We need you to deposit $3 billion in cash by breakfast." $3 billion. For a young company like Robinhood, that was an impossible number. It was more cash than they had raised in their entire existence. This wasn't a request, it was a financial death sentence. This is the moment where the free trades business model collided with reality. Traditional brokers, the Schwabs and Fidelities of the world, have been around for decades. They have immense balance sheets, deep cash reserves built from years of charging commissions and fees. They could, theoretically, handle a shock like this. But Robinhood was built differently. It was built to be lean, fast, and frictionless. Its revenue came from a controversial practice called payment for order flow, something we'll dissect later, which relies on massive volume, not massive cash reserves. They were a speedboat in an ocean of aircraft carriers, and they had just been caught in a financial hurricane. They had a choice, an impossible choice. Option 1. Fail to meet the collateral call. If they did that, the NSCC would step in, declare them in default, and begin liquidating all their positions. Robinhood would cease to exist. All of its customers' accounts would be frozen and unwound. The chaos would be unimaginable. Option 2. Find a way to drastically, immediately reduce the risk on their books. How do you do that? You stop letting people take on more risk. You stop them from buying the stocks that are causing the volatility. They chose option 2. They restricted buying on GameStop, AMC, and a handful of other meme stocks. They didn't block selling. In fact, they wanted people to sell because every share sold reduced their overall risk and lowered that $3 billion demand. It wasn't a conspiracy to help the hedge funds. It was a desperate, panicked act of self-preservation. They were trying to stop the ship from sinking. By turning off the buy button, they effectively slammed the brakes on the squeeze, giving the hedge funds the breathing room they needed to start covering their shorts without driving the price to infinity. But from Robinhood's perspective, they weren't saving the hedge funds. They were saving themselves from a margin call sent by the market's plumbing system. This is the hidden price of free. The democratization of finance came with a catch. The platforms that made it so easy and cheap to trade were the least equipped to handle the chaos when the masses actually showed up and decided to challenge the old guard. The system that was supposed to empower the little guy was built on a foundation that couldn't support the weight of their collective will. When the people used the tools they were given to actually move the market, the infrastructure buckled. The house wasn't a casino rigging the game against you. It was the building's foundation, which started to crack under the strain, forcing the landlord to evacuate everyone from the most exciting room in the building. The very thing that made Robinhood revolutionary, its accessibility and low barrier to entry, also made it fragile, and that fragility was exposed in the most brutal way possible, leaving millions of its users feeling betrayed, locked out of the biggest financial event of their lives. The stage was set in the unlikeliest of places, a subreddit called Wall Street Bets, a chaotic corner of the internet known for its high-risk, often meme trading strategies. The target was GameStop, a brick-and-mortar video game retailer that Wall Street had left for dead. Professional hedge funds, most famously Melvin Capital, were shorting the stock, making a massive bet that its price would continue to fall into oblivion. Shorting, in simple terms, is borrowing a stock, selling it, and hoping to buy it back later at a lower price to return it, pocketing the difference. It's a bet on failure. But there's a catch, a hidden danger that Wall Street sometimes forgets. While the most you can make is the full price of the stock if it goes to zero, your potential losses are, theoretically, infinite. Because a stock's price can go up forever. The users on Wall Street Bets saw this. They saw that GameStop was one of the most heavily shorted stocks on the market. They realized that if enough of them started buying the stock, they could drive the price up. This wouldn't just make them money. It would inflict catastrophic pain on the short sellers, who would be forced to buy back the shares they borrowed at a much higher price to cut their losses. This act of forced buying would, in turn, drive the price even higher. It's a vicious feedback loop known as a short squeeze. And it was the perfect weapon for a digital populist uprising against the financial elite. Using apps like Robinhood, millions of small-time investors, armed with stimulus checks and a deep-seated resentment from the 2008 financial crisis, piled in. They weren't just buying stock. They were joining a movement. It was David versus Goliath with memes as slingshots. And for a few glorious days, David was winning. The price of GameStop, which had been trading at just a few dollars a share months earlier, exploded. It shot past $50, $100, $200, $300, topping out at over $480 a share. People were posting screenshots of their accounts, showing life-altering gains. Students were paying off their loans. People were buying houses. It was a wealth transfer of historic proportions, from the pockets of hedge funds to the accounts of ordinary people. Robinhood was the hero, the great equalizer, the tool that had finally, as its mission statement promised, democratized finance. And then, on the morning of January 28, 2021, the revolution was stopped dead in its tracks. Users logged into their Robinhood accounts to find something unthinkable. They could no longer buy GameStop, or AMC, or several other so-called meme stocks. The buy button was gone. They could only sell. The effect was instantaneous and devastating. A short squeeze is fueled by relentless buying pressure. By turning off the buy-side tap, Robinhood had single-handedly broken the momentum. The price began to plummet. Panic selling ensued. The hedge funds that were on the brink of collapse were given a lifeline, an opportunity to escape their disastrous positions at a lower price. The retail investors who had just been celebrating were now trapped, watching their fortunes evaporate in real time. The app that had been their weapon was now being used against them. The feeling of betrayal was absolute. The platform that claimed to be for the little guy appeared to have sided with the Wall Street giants at the most critical moment possible. The outrage was a tidal wave. Accusations flew. Lawsuits were filed. Politicians from both sides of the aisle demanded answers. Was this a backroom deal? Was Robinhood ordered by the big market makers, the very firms that paid them for order flow, to crush the retail uprising and save their hedge fund buddies? The conspiracy theories wrote themselves. But the truth, as it so often is, was both more complicated and, in a way, more damning for the free trading model. Robinhood CEO Vlad Tenev went on television and frantically tried to explain. He insisted it wasn't a conspiracy. He claimed their hand was forced. He said they didn't have a choice. And the reason he gave pointed directly to the invisible plumbing of the stock market, a system that every free trading app relies on, but that almost no user ever sees. The clearinghouse. Think of a clearinghouse as the financial system's escrow agent. When you click buy on a stock, the transaction is an instant. It takes 2 business days to officially settle, a period known as T+2. In those 2 days, anything could happen. The buyer could run out of money, or the seller could fail to produce the shares. To prevent the whole system from collapsing, a third party called a clearinghouse steps into the middle of every single trade. In the US, the main one is called the National Securities Clearing Corporation, or NSCC. The NSCC guarantees the trade. It ensures the seller gets their money and the buyer gets their stock no matter what. To manage this immense risk, the NSCC requires brokers like Robinhood to keep a security deposit with them. A massive pile of collateral. The size of this deposit isn't fixed. It changes based on how much risk the clearinghouse perceives in the broker's trades. If your customers are all buying stable blue-chip stocks, your deposit requirement might be relatively low. But if your customers are all piling into an incredibly volatile stock that's swinging hundreds of dollars in a single day, the risk of trades failing skyrockets. The clearinghouse sees this and gets nervous. It turns to the broker and says, "The risk you're bringing into the system is off the charts. We need you to post dramatically more collateral right now to back up these trades." This is exactly what happened to Robinhood. In the middle of the GameStop frenzy, the NSCC woke them up in the pre-dawn hours with a bill for $3 billion. An urgent collateral call that had to be paid immediately. Robinhood, for all its success, was still a private startup. It did not have $3 billion in liquid cash just sitting around. They were facing a catastrophic liquidity crisis. If they couldn't post the collateral, they would be in default, and the NSCC could shut down their trading entirely, potentially taking the whole company down with it. So they panicked. They had to reduce their risk profile, and they had to do it immediately. The fastest way to do that was to stop customers from taking on more risk. And the riskiest positions, in the eyes of the clearinghouse, were the new buy orders for these hypervolatile stocks. So they turned off the buy button. It wasn't, they claimed, to protect the hedge funds. It was to protect themselves from imploding. Their free and accessible model had attracted so many users and so much concentrated, risky activity that the underlying financial plumbing simply broke. But here is where the story gets truly murky, and where the free business model comes back to haunt them. Remember how Robinhood makes its money? Payment for order flow. Selling its customers' trades to giant market-making firms. One of the biggest of these firms, handling a huge portion of Robinhood's orders, is Citadel Securities. The founder and CEO of Citadel Securities is a man named Ken Griffin. At the exact same time all of this was happening, another one of Ken Griffin's companies, the hedge fund simply called Citadel, had just joined a multi-billion-dollar bailout to rescue Melvin Capital, the very hedge fund being crushed by the GameStop squeeze. So let's just pause and look at the picture this painted for the world. Robinhood's biggest business partner, Citadel Securities, was intrinsically linked to a hedge fund, Citadel, that had a direct $2 billion interest in seeing the GameStop squeeze come to an end. Then Robinhood makes the unprecedented decision to halt buying, which does exactly that. It ends the squeeze, saving Melvin Capital and Citadel's investment. Even if Robinhood's official story about the clearinghouse is 100% true, and subsequent investigations suggest the collateral call was indeed the primary trigger, the optics are an absolute nightmare. The very structure of their free business model created a glaring, undeniable conflict of interest at the worst possible moment. Whether there was an explicit backroom phone call or not became almost irrelevant. The system itself seemed rigged. The platform that was supposed to empower the little guy was financially intertwined with the very Goliaths he was trying to slay. The fragility of their model wasn't just about technical plumbing, it was about trust. And in a single morning, Robinhood had burned it all to the ground. The fallout was just beginning, and it would lead all the way to the halls of the United States Congress. On February 18, 2021, the House Financial Services Committee convened a virtual hearing. The title was GameStop? Who wins and loses when short sellers, social media, and retail investors collide? And the witness list was a Hollywood casting director's dream. You had Vlad Tenev, the CEO of Robinhood, looking pale and beleaguered. You had Ken Griffin, the billionaire founder of Citadel, one of the most powerful and feared men on Wall Street. You had Gabe Plotkin, the head of the now infamous hedge fund Melvin Capital, who had reportedly lost over 50% of his fund's value in a single month. And then you had Keith Gill, Roaring Kitty himself, sitting in a gaming chair wearing a red headband, with a poster of a cat hanging on the wall behind him. The juxtaposition was staggering. It was the entire saga distilled into 4 Zoom windows. The central question, the one that echoed through every lawmaker's 5-minute slot, was simple: why? Why did Robinhood and other brokers suddenly halt the buying of GameStop and other meme stocks? The most popular theory, the one that had solidified into gospel on Reddit, was pure conspiracy. It went like this. Ken Griffin of Citadel, whose firm makes billions processing Robinhood's customer orders, and who had also just thrown a multi-billion-dollar lifeline to the bleeding Melvin Capital, picked up the phone, called Vlad Tenev, and told him to shut it down, to stop the squeeze, to protect his investment and save his friends on Wall Street from total annihilation. It was a clean, simple narrative of corruption, the powerful protecting the powerful. Under oath, both Tenev and Griffin flatly denied this. They swore no such conversation ever took place. They insisted Citadel had no influence, no input, and no advance knowledge of Robinhood's decision to restrict trading. So, if it wasn't a smoky backroom deal, what was it? The truth, as it so often is, was far more technical, far more bureaucratic, and in some ways far more terrifying. It wasn't about a single villain, but about the very plumbing of the financial system itself. Plumbing that was never designed for an army of Redditors armed with zero-commission trading apps. To understand what really happened, you have to understand the boring, invisible entity at the heart of the U.S. stock market, the Depository Trust and Clearing Corporation, or DTCC. Think of the DTCC as the central nervous system. When you click buy on your app, the stock doesn't just magically appear in your account. There's a 2-day settlement period, known as T+2. For those 2 days, the DTCC, through its subsidiary the NSCC, basically guarantees the trade. It takes on the risk that in those 48 hours, the buyer won't have the money or the seller won't have the shares. To manage this risk, the clearinghouse requires brokers like Robinhood to post collateral, essentially a security deposit, against all their outstanding trades. Normally, this is a predictable, manageable cost of doing business. But on the last week of January 2021, things were not normal. GameStop stock was moving with the kind of volatility usually reserved for unstable isotopes. With every tick up, the risk for the clearinghouse exploded. What if the price collapsed in the next 48 hours and all these new retail buyers couldn't cover their positions? The DTCC wasn't about to be left holding the bag. So, it did what its risk models told it to do. It demanded more collateral. A lot more. At around 3 a.m. on Thursday, January 28th, an automated email landed in the inbox of Robinhood's operations team. It was from the NSCC. The message was a gut punch. Their deposit requirement, which was normally a manageable figure, had skyrocketed. They were being asked to post $3 billion. $3 billion. With a B. And they needed to have it by 10 a.m. that morning. For perspective, Robinhood as a company was only valued at around $12 billion at the time. This wasn't a request. It was a threat to their very existence. They simply did not have $3 billion in liquid cash just sitting there. The company was on the brink of failure. So they scrambled. They got on the phone with the NSCC and managed to negotiate the requirement down. But to do that, they had to prove they were reducing their overall risk profile. And what was the single biggest source of risk on their books? The tsunami of buy orders for GME AMC and a handful of other meme stocks. So they made a choice. It was a brutal, desperate choice made in the pre-dawn hours by a company staring into the abyss. They cut off the source of the risk. They turned off the buy button. They didn't stop people from selling. In fact, they wanted people to sell because every share sold reduced their risk and lowered their collateral requirement. They only stopped the buying. This was the no conspiracy explanation. It wasn't Ken Griffin on the phone. It was a risk model in a computer at the DTCC. It wasn't a plot to save the hedge funds. It was a desperate act of self-preservation to save Robinhood itself from imploding due to an unprecedented collateral call. And subsequent investigations, including a detailed report by the SEC, largely backed this up. They found no evidence of a secret plot. The plumbing of the system had simply buckled under the pressure. But here's the problem. For the millions of users who had piled into GameStop, this explanation felt just as bad, if not worse. The conspiracy theory was, in a way, comforting. It had a clear villain. You could be angry at Ken Griffin. But the reality was that the system itself was the villain. The very infrastructure of the market was built in a way that when the little guy finally, for the first time ever, got the upper hand, the system automatically triggered its own defenses. The circuit breakers, the collateral requirements, the very rules of the game were designed to protect the house, not the players. It revealed a fundamental, maddening paradox at the heart of Robinhood's mission. They had claimed to democratize finance. They gave millions of people access to the casino. But when those people started winning, and winning big, the casino manager came over, took their chips, and told them they could only cash out, not place any more bets. It didn't matter if the order came from a rival billionaire or a faceless clearinghouse algorithm. The result was the same. The game was halted, the momentum was killed, and the hedge funds that were on the ropes were given a crucial moment to breathe, regroup, and reposition. The trust that had been the bedrock of Robinhood's explosive growth evaporated in an instant.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
It was replaced by a deep simmering resentment, the feeling that the game was and always had been rigged. Robinhood survived. They made frantic calls to their venture capital investors and raised billions in emergency funding within hours to meet their obligations. But the damage was done. They had successfully democratized access to the market, but they had failed to change the market's underlying power structure. The GameStop saga didn't just expose a liquidity crisis at a single FinTech startup. It ripped the cover off the entire zero-commission model and forced everyone to ask a much more fundamental question. If trading is free, how does a company like Robinhood make money? And do those methods of making money create conflicts of interest that ultimately harm the very retail investors they claim to empower? The fury over the buy button being switched off was the catalyst, but it pointed to a deeper truth about the business of free trading. Because when you looked closer at how the money really flows, you realized that payment for order flow was just the tip of the iceberg. The real product being sold wasn't stocks, it was the investors themselves. And this is where the rabbit hole gets so much deeper. Because to say you are the product is an understatement. You're not just the product, you are the oil field, the gold mine, and the factory all rolled into one. Every single action you take inside that app is meticulously logged, analyzed, and monetized in ways that make payment for order flow look like a corner lemonade stand. Think about it. Every stock you search for, every chart you zoom into, every article you read in their newsfeed, the stocks you add to your watch list and the ones you remove, how long you hesitate before hitting the buy button, the time of day you're most active, all of it. It's an ocean of behavioral data, and in the 21st century, that data is one of the most valuable commodities on Earth. First, the brokerage uses this data on itself. They A/B test everything. Should the buy button be green or a brighter green? Should they send you a push notification when a stock on your watch list drops 3% or 5%? What headline in the newsfeed is most likely to make you click and then trade? They are psychologically profiling their entire user base in the aggregate to discover the perfect combination of triggers to maximize engagement. And in this world, engagement is a sanitized corporate word for trading activity. More activity means more order flow to sell, which means more revenue. They are reverse engineering your own financial habits to encourage you to do more of the things that make them money. But that's just the internal warm-up. The real money is in selling this data externally. Now they'll tell you it's all anonymized and aggregated. And that may be true. They're not selling a list with your name on it saying, John Smith is about to buy 10 shares of Tesla. But they don't need to. What they are selling is something far more powerful. A real-time map of retail investor sentiment. Imagine you're a massive, multi-billion-dollar hedge fund. Your entire existence depends on having an informational edge, knowing something the rest of the market doesn't, or knowing it a few seconds earlier. For decades, you've paid fortunes for what's called alternative data. You'd buy satellite imagery to count cars in Walmart parking lots to predict retail sales. You'd analyze credit card transaction data to see if Starbucks was having a good quarter. Now a new, even more potent form of alternative data exists. The collective brainpower of millions of retail investors, served up on a silver platter. These hedge funds and high-frequency trading firms will pay a premium to know that. In the last 60 minutes, 100,000 users on a popular trading app have all added a specific biotech stock to their watch list. They want to know that searches for a particular EV company have spiked by 1,000%. This isn't insider trading. It's something new. It's outsider in trading. They are looking at the aggregated intentions of the retail crowd and using their massive capital and high-speed algorithms to get in front of the wave before it even crests. By the time that army of retail investors decides to actually hit buy, the big fish are already in position, ready to sell their shares to you at a slightly higher price. The data on your intention to trade was monetized before your actual trade was. But even that is not the most audacious part of this business model. There's another revenue stream, humming quietly in the background, that is so brilliantly ironic it's almost poetic. It's called securities lending. When you open an account with most of these brokers, especially if it's a margin account, you agree to terms and conditions that are hundreds of pages long. Buried deep within that legal text is a clause that gives the brokerage the right to lend out the shares you own to other parties. You still own the shares, you get the dividends, you see them in your portfolio. But physically, or at least digitally, they might not be sitting in your account. They've been loaned out. So who on earth is borrowing your shares? The answer primarily is short sellers. These are the very hedge funds and institutional investors who are betting for your stock to go down. In order to short a stock, you must first borrow shares, then sell them on the open market, hoping to buy them back later at a lower price to return to the lender. And who provides them with those shares to borrow? Your free brokerage. And what does your brokerage get in return? They charge the short sellers a fee and interest rate for the loan. For highly sought-after, volatile stocks, the very meme stocks, that these platforms often encourage you to buy and hold with diamond hands, the borrowing fees can be astronomical. Let this sink in. The platform that built its brand on democratizing finance and empowering the little guy is actively taking your shares, the ones you bought to support a company you believe in, and lending them to the most powerful players on Wall Street who are using those exact shares to bet against you and try to drive the price down. The brokerage profits from your buy order via payment for order flow. Then, they profit again by lending your shares to people trying to make your investment fail. They are playing both sides of the chessboard against the middle, and you are the middle. They win when you buy, and they win when others bet against you. It is a perfect, self-contained money-making machine. And it doesn't stop there. What about the money you haven't invested yet? That cash just sitting in your account, waiting to be deployed? That's another untapped gold mine. It's called a cash sweep program. Your uninvested cash doesn't just sit in a digital shoebox with your name on it. At the end of each day, the brokerage sweeps all the idle cash from its millions of customer accounts into interest-bearing accounts at affiliated banks. We're talking about billions upon billions of dollars in aggregate. These banks pay the brokerage a healthy interest rate on that colossal pile of cash. The brokerage then passes on a tiny fraction of that interest to you, or more often, nothing at all. The difference between what the brokerage earns on your cash and what they pay you is called the spread, and it is pure risk-free profit for them. In a rising interest rate environment, this becomes one of their single biggest revenue sources. They're making hundreds of millions of dollars a year, not on your trading but on your inactivity, on the cash you're too scared or too busy to invest. So let's recap the business model of free. They make money by selling your trades to high-frequency traders. They make money by packaging and selling your behavior as data to hedge funds. They make money by lending out your own stocks to people betting against you. And they make money by earning high interest on your idle cash while paying you little to nothing. It is an engine designed to monetize every facet of your financial life. Your actions, your inactions, your holdings, and your intentions. They have built a perfect system that profits whether you win or lose. But this intricate machine has a hidden cost. A systemic risk that goes far beyond your individual portfolio. And understanding that risk is the final, most crucial piece of the puzzle. This risk isn't about one stock going to zero. It's about the very plumbing of the financial system choking on the sheer volume of free trades. To see it, we have to look at the one event that ripped back the curtain and showed everyone the terrifying gears grinding underneath: the GameStop saga. For a few weeks in January 2021, the world was captivated by a story of David versus Goliath. A legion of retail investors, coordinating on Reddit, seemed to be taking down billion-dollar hedge funds by buying up shares of a struggling video game retailer. Felt like a revolution. But then, on January 28th, the revolution was put on hold. Apps like Robinhood suddenly and inexplicably restricted the buying of GameStop and other so-called meme stocks. The outrage was immediate and bipartisan. Users screamed manipulation. Politicians demanded hearings. The narrative was simple. The powerful were changing the rules to save themselves. And while there's an element of truth to that, the real reason was both more technical and infinitely more frightening. It revealed the fragile single point of failure upon which this entire democratized system is built. When you buy a stock, the transaction isn't instant. It takes 2 days to settle. In that 2-day gap, anything could happen. The buyer could run out of money. The brokerage could go bankrupt. To protect the entire system from this risk, there's a central gatekeeper, an entity most people have never heard of called the Depository Trust and Clearing Corporation, or DTCC. The DTCC is like the market's central nervous system. It guarantees every single trade will be completed, but it doesn't do this for free. It demands collateral. Every brokerage has to post a massive deposit with the DTCC, like a security deposit on an apartment, to cover the value of all their unsettled trades. The more trades a brokerage has, and the more volatile those stocks are, the more money the DTCC demands as collateral. Now, think about what was happening with GameStop. Millions of users on a single app were buying the same hypervolatile stock all at once. The volume was unprecedented. From the DTCC's perspective, this was a 5-alarm fire. The risk was astronomical. So, in the middle of the night they called Robinhood. And they didn't ask for a small increase in their deposit. They demanded billions of dollars in new collateral. Billions. Immediately. Robinhood didn't have it. No company just has $3 billion in cash lying around. They were facing a catastrophic liquidity crisis. They had two choices. Either find billions of dollars in a matter of hours or stop the buying. By halting purchases of GameStop, they could stop the flood of new risky trades, which would stop their collateral requirement from spiraling even further into the stratosphere. So they slammed the brakes. This wasn't just a Robinhood problem. This was a systemic problem. The zero-commission model, which encourages millions of people to make countless small trades, created a situation the market's plumbing was never designed to handle. It revealed that the price of democratizing finance was the creation of a system so fragile that a popular meme could threaten to bring it to its knees. The very thing that made the app so successful, their massive active user base, became their greatest vulnerability. And this vulnerability points to an even deeper, more concentrated risk. Where does all this retail order flow go? As we've learned, it goes to a handful of massive wholesale market makers, firms like Citadel Securities and Virtu Financial. These aren't just participants in the market. For retail investors, they essentially are the market. An incredible 40 to 50% of all U.S. retail stock volume is handled by just one of these firms. This is a staggering concentration of power and risk. The entire free trading ecosystem is utterly dependent on these few giants to function. They are the buyers of the order flow, the executors of the trades, and the providers of the liquidity that makes it all seem so seamless. But what happens if one of them stumbles? It's not a hypothetical question. In 2012, a market-making firm called Knight Capital deployed new trading software. A bug in the code caused it to run wild, buying and selling hundreds of millions of shares in minutes. In just 45 minutes, the firm had lost $440 million and was on the brink of collapse, threatening to send shockwaves through the entire market until it was bailed out by a consortium of other firms. Now imagine a similar event happening today, but with a firm that's exponentially larger and more central to the system than Knight Capital ever was. A technical glitch, a cyber attack, or a sudden unexpected market shock that triggers a liquidity crisis at one of these behemoths could freeze the gears of the entire retail trading machine. The buy button on your app wouldn't just be grayed out for one stock. It could be grayed out for everything, because the central hub that processes the trades has gone dark. This concentration of risk is amplified by the third and most unpredictable systemic threat: behavioral contagion. These apps weren't just designed to make trading easy. They were designed to make it social, viral, and addictive. The confetti, the leaderboards, the simple game-like interface. It all encourages herd behavior on a scale never seen before. Social media platforms like Reddit and Twitter act as a massive echo chamber, a digital accelerant for financial manias. A rumor or a compelling due diligence post can send millions of traders stampeding into the same stock or option, creating flash mob volatility that has absolutely nothing to do with the company's underlying value. This isn't the wisdom of the crowd. It's the madness of the mob, and it introduces a new chaotic variable into the market that even the most sophisticated hedge funds struggle to price. The meme stock phenomenon is a permanent feature now. It's a new form of risk where market mechanics are driven not by earnings reports and balance sheets, but by social media sentiment, viral trends, and the collective gambling impulse of millions of people. And our regulators are sprinting to catch up to a reality that has already left them in the dust. The laws governing our markets were written for an analog world of telephones and professional brokers, not for a digital world of algorithms, influencers, and zero-commission apps that can mobilize an army of traders with a push notification. The SEC has published lengthy reports, they've debated the merits of payment for order flow, and they've acknowledged the risks of gamification. But the market is evolving faster than the rulebook can be rewritten. So when you put all the pieces together, the hidden costs of payment for order flow, the psychological hooks of gamification, the operational fragility revealed by GameStop, the concentration of power in a few market makers, and the unpredictable nature of behavioral contagion, a final sobering truth emerges. For decades, the old saying on Wall Street was, "If you're not paying for the product, you are the product." But that's no longer sufficient. It's more profound now. When you use a free trading app, you are not the customer. The market maker is the customer. You are not just the product being sold. Your behavior, your data, your activity, that is the raw material. You are the oil field from which value is extracted. But most importantly, you are not really a player in the game. You are the game itself. Your collective clicks, your swipes, your hopes, your fears, your FOMO, and your panic sells. All of it is aggregated, analyzed, and monetized. It forms the very foundation of a multi-billion-dollar machine that was built not to serve you, but to run on you. The machine profits from your engagement, it profits from your order flow, and it profits from the volatility you create. It is a perfect system, designed to extract value from your presence in the market, whether you win or lose. This is not an argument to stop investing. It is a plea to open your eyes. To understand that when you open that sleek, friendly app, you are not just managing your money. You are jacking into a matrix, a complex and often predatory ecosystem where the odds are subtly, but systematically stacked against you. The true path to democratizing finance isn't free trades. It's free and total information. It's understanding the architecture of the system you're participating in. So the next time you see an ad promising a free stock just for signing up, ask yourself the real questions. What is the business model? Who are the real customers? And what is the hidden price I am paying for the privilege of free? Because in the modern market, the most valuable investment you can ever make is in understanding the rules of the game. Once you see the machine for what it is, you can finally begin to make it work for you instead of the other way around.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.